Live from New York City this morning. Good morning, good morning. Trying to stage a rally here. The S&P up 0.8%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, we begin with the big issue. What a year for bad forecasts. 12 months ago, the Federal Reserve saw rates climbing to just below 1%. 12 months later, and chair powell was hiking through 4%. Wall Street strategists hardly sharing themselves in glory either. The average estimate coming into the new year was just below 5K. The S&P closing yesterday about 200 points south of 4,000. So bear that in mind as we prognosticate ahead of a new year. The stage is already set for someone to be very, very wrong.
The Fed has a problem.
It's trying to push markets to a place that markets don't want to go.
If you look at the futures market, they're expecting rate cuts pretty quickly.
The market has priced in the Fed cutting in the second half of the year.
They're not taking the Fed very seriously.
There is still that sort of tendency to try and price in early rate cuts.
With a disconnect in the market right now.
That's the big question mark.
The market refuses to price out those Q4 2023 rate cuts.
The market does not believe the Fed has credibility to stick to its guns in terms of raising rates.
The market doesn't quite believe the Fed's going to get over 5%.
Markets have been conditioned to actually not believe the Fed.
Joining us now to discuss, I'm pleased to say, is Morgan Stanley's Jim Karen, Darrell Cronk of Wells Fargo alongside him. Jim, great to see you, sir. Let's start with that question. The Fed projects no cuts. The market says we're going to be cutting. Who's going to be right?
In this environment, I would say that the Fed's going to be correct. I think the market has it a little bit wrong here. Look, when we look at the forwards, what the forwards in the Fed funds futures are telling us is that it's increasing the probability that there's going to be a recession at some point. That's why there's a downward slope. The Fed needs to get this job done. Even under their forecasts, they see inflation in 2023 at 3.5%, which is above their target level. So unless something dramatic happens, all else being equal, I think the Fed is going to keep rates at, I think, the 5 to 5.25 level, which is what they told us last week. And I think that they're going to hold it there. And I think that what the market's pricing in is just building in a recession probability. And that's why we see this downward slope in Fed funds futures. And that's what's creating some of the confusion in the markets.
Jim, we've got this cute story of a recovery in the back half and some dreadful news in the front half. Do you think we're oversimplifying things looking out to next year?
I think we are. And look, I can flip that story around and I can say that in the first half of next year, it could be more positive because, look, we already know what the earnings forecasts are. So that's probably already priced in. We know that the inflation's is already peaked and is coming down. We know the Fed's stopping and China may reopen in the first half of the year. So the first half of the year could be the big surprise where it keeps things more positive than what people are thinking because they're so negative. That would be counter consensus. That could be the surprise. And then in the second half, we could see inflation not come down or not become anchored. And that could cause the Fed to get back into the game and start hiking rates. So look, this is a very, very confusing, pivotal year for 2023.
That's the tail risk going into next year. Darrell, you're looking for recession, recovery and rebound all at once in 23. Is that right?
That's right, John. I mean, I agree with Jim. It's going to be a tough year. There's so much happening and so much going on. In the spirit of the holidays, a little bit of the rates market has the substance of things hoped for, right? Hoping for rate cuts in the back half of the year. The Fed continues to say, hear what I'm saying. Don't just listen to my press conference, but truly hear what I'm saying. We are not stopping till we get to 2%. And even as we get closer to that, we see material declines in inflation, we are going to hold the line and not ease rates very quickly. The reality is, and you see it in the rate markets, in the last 11 trading days, we've gone from 83 basis points inversion on the 2s to 10s to 55 this morning, right? So things are resetting very quickly. And I think that's going to have investors on their toes early into 2023.
Oh, it's hard to keep up. I look at the 10-year right now at 362, the 2-year at 420, yields lower, to your point, Darrell, this morning. Let me give you some estimates. This from Mike Schumacher of Wells yesterday. He sees the 2-year nominal yield back to the high 4s, the 10-year back to 425. The same day, different conversation. B. Mosey and Lingen had this to say to us yesterday on Bloomberg Surveillance. The 10-year and the 2-year heading back towards 3%. over the next 12 months. Darryl, on the one side, you've got the high 4s on a 2-year. On the other side, someone's saying 3. That's a very, very different story, isn't it?
It is a very different story. If you get the 2 years back to 472, that's the peak, right? 472 on the 2s, 4.25 on the 10s were our highs in the rates. So you've got to believe rates are going higher. You know, it's well documented. People have talked about it on your show before that, you know, the 2-year has to be above the terminal rate of Fed funds, at least historically, or that's always happened. If that's the case, and we're going to 5.1 on the terminal rate, you've got to think the 2-year has to come up. So the risk could actually be in the short side of the curve as rates start moving up. You're going to get protected from duration, but the reality is if those rates need to reset to those types of levels, certainly the market is not anticipating that or pricing for it today.
This is worth exploring further. Jim, you know how the story goes at the moment. We've seen the bulk of the hiking cycles. Next year's about the price we've got to pay for them. But then I look to Europe. I'm looking at Italy and Germany in the previous 4 days before today, with the front end up somewhere between 40 basis points and 50 basis points over just 4 sessions. Jim, do you buy it that the hiking cycles are priced in when the ECB is saying we're not sufficiently restrictive, the Fed says we're not there yet, and I'm hearing more and more people say the BOJ might join the party next year?
John, I think that's the point. I don't believe the hiking cycles are sufficiently priced in. I think what's priced is quite the opposite. I think what's priced is that people expect rates to come down. And I think we need to listen to what these central bankers are saying, that they are worried about inflation. Look, you mentioned Ian Lingen and you also mentioned Michael Schumacher, 2 very smart people who have 2 very, very different forecasts. What that tells us is that the tails are very fat in either direction. So at the risk of getting too mathematical here, what we have as a distribution for risk as we go into 2023 is a very short, fat distribution, which means that you have higher volatility in those types of environments because the likelihood that you could go to one side of the risk spectrum, 3% 10s or 4.25 or 4.5% 10s, are almost equal. They're probably 25, 30% each in probability. So those are fat tails. Those are reasonably high risk events that could happen either one. So you could bounce around back and forth quite a bit depending on how the data materializes. And I think that's what we're in store for in 2023.
So Jim, $1 trillion question. How do you invest around that into next year?
So look, I think you have to have a very, very balanced approach. From a duration perspective, I want to be short, but not too short, around the 3-year duration mark in treasuries. I'd like to build that with some high quality, but I'd also like to build in some of the lower quality credit risks in there. So maybe a little bit of high yield and I mean, certainly investment grade. But I think there's opportunities. Emerging markets could also have some opportunity there too. So those might be on the riskier side. But then you also have to own some U.S. treasuries and some high quality credit in order to balance that risk. On average, when you put it together, I think you need to end up at about a 3-year distribution. I'm sorry, a 3-year duration. And most important, you have to start to control for risk-adjusted returns. We have to think about risk-adjusted returns. There's no one trade that's going to get you there. It's going to be a portfolio of trades and balancing those risks.
Darryl, what about you on the equity side?
On the equity side, we think it's a little more difficult. You've got to really pay attention. It's interesting. So the dollar peaked roughly 11 weeks ago. Rates peaked about 7 weeks ago. Both of those should have been really good news for equities. Neither of them have been good news for equities, right? Growth continues to underperform. Equities continue to underperform. You've got a downward sloping 200-day moving average with now a downward sloping 20-day moving average. History tells you when that happens, you get out of the way. The equity risk premiums still are close to their 2022 lows, so the risk-reward trade-off heading into next year just isn't quite there yet. We think it'll get there in 2023, but it's not there yet. And the other point I would just make to Jim's point on volatility, so it's not just the rates market, it's obviously the currency markets. I mean, obviously we know what happened with the BOJ yesterday morning, but there was a 6 standard deviation move in the yen yesterday. That happens 2 times out of 1 billion times, 1 billion times. I mean, that is a huge transmission mechanism that I think we have to be cognizant of as we get ready to turn the calendar to 2023.
We need to talk about it right now. Dollar yen at 132. Wow's Eric Nelson looking at 125. I'm sure you've heard that call, Darryl. I asked the question, you've all heard me ask it over the last 24 hours or so. Was the move from the BOJ yesterday to just move the threshold, the band for the 10-year to trade in, with an upper limit now of 0.5%, was that a step towards normalization? Or was that about setting policy on a more sustainable path to remain and retain that dovish stance of the BOJ? And I heard a lot more people say it's the former and not the latter. Take a listen to what Mohammed Al-Arian had to say on this program just yesterday.
There's no doubt in my mind that this is the step towards normalization. The good news for them is I think they can control the process. That's actually good news for global markets because it doesn't force selling by Japanese institutions. However, over time, even this approach becomes unsustainable.
As Mohammed said that, ping on the Bloomberg, Jim Karen and Morgan Stanley messaged me straight away. So, Jim, let's talk about it. You asked the question, what are the second-order effects of markets leveraged to low and stable yields as we blow up that whole thing in 22 into 23?
So what we have to understand with the yen and Japanese policy rates is that that is the universal cost of leverage. So we've all heard about the yen carry trade. We've all heard about people borrowing in yen because the interest rates are so low. And what they do with that money, what they do with that yen is they convert it into other currencies and do other things with it, which means that if the cost of borrowing, if the cost of leverage is starting to go up in Japan, then that means the cost of leverage globally is starting to rise and is likely to stay high. Whenever leverage costs start to move higher, this creates a lot of potential risks that are in the market. So I think Mohammed's absolutely right. This is a start of a path towards normalization for Japan, but what they're trying to do is control it at a very, very slow pace. If they can do that at a slow pace, then I think we may be okay with this, but things never seem to work out that way. There's always an over-levered player out there with the cost of leverage going up where it creates a problem, and then there's a knock-on effect. So that's what I'm concerned about. It's a known unknown that's in the markets that I think is going to keep risk premium high.
Daryl, do you think they can control it?
I think what's interesting about yesterday is, yes, they're trying to control it. The market was surprised by the move, but reality is, had they laid their hand down and shown it ahead of time, the market would have pushed them, and the rates market would have pushed them right to the edge of that band, right? So they had to surprise, number one. Number two, what's not talked about enough is they tightened by widening the band, right, to 50 basis points on either side of zero, and also eased simultaneously by increasing the purchases of yen or JGBs, excuse me, from 7.3 trillion to 9 trillion in yen. Why did they do that? They're tired of people shorting the yen, right? So it's a way of widening the band, starting to normalize, and still by increasing that firepower from the BOJ to go in and buy JGBs as they need to, it scares off those shorts, basically, and keeps rates from going even higher. So they're controlling it in a way that they know how to do that. It also likely buys time for Kuroda's successor in March, April, to have a little bit of time to form the new policy on yield curve control as they go.
So we'll be watching that. We'll also be watching investor flows. Jim, it feels like we're going back to what we used to do 10 years ago, just seeing where Japanese investors and where that money's flowing to. Wells Fargo wrote this yesterday. This was Eric Nelson. Daryl, I'm sure you've read this too. Japanese demand for US Treasuries and other foreign bonds should deteriorate further. Jim Karen, can you speak to that? What are the chances, the possibility of that happening? And what does it mean for how things shape up in the Treasury market?
Yeah, so effectively what we're saying there, or what's being said there, is that as Japanese yields rise, they become more attractive. JGBs become more attractive to local domestic Japanese investors, and they have less need to go outside of Japan and buy U.S. Treasuries. We always have to recognize that U.S. Treasury yields are higher, but you also have to pay for the currency, and sometimes that currency exchange will take away all the extra yield. So the more Japanese yields start to move higher, the less demand there is, by definition, for U.S. Treasuries. So here we are at a stage where U.S. yields have risen. They've gone up. The Fed is hiking interest rates, and one of the biggest buyers of U.S. Treasuries is Japan. So as those Japanese rates start to go up, that could put some pressure on U.S. Treasury yields also moving higher. So that's something to also watch.
Jim Karen, Daryl Crump, sticking with us. Fascinating conversation, really smart stuff on this bond market. The 10-year in Japan, just 3 basis points short of that new upper limit of that yield curve control band. In the Treasury market, yields are lower this morning by 5 basis points on a 10-year to 363. Coming up, President Zelensky heading to Washington, D.C.
Our focus from a DoD standpoint is to continue to communicate with Ukraine, our allies and our partners, to ensure that the Ukrainians have the security assistance they need to be successful on the battlefield.
We will catch up with AMH and Maria up next.
We continue to see intense fighting in the region of Bakhmut, with Russian forces making very incremental gains. President Zelensky, we continue to see his leadership be a key aspect to Ukraine's success in their fight. Clearly, we've made a commitment to continue to support Ukraine for as long as it takes in terms of security assistance.
President Biden set to offer additional military assistance and nearly $2 billion to Ukraine as President Zelensky plans a visit to the White House later today. This coming as China opens up for a dialogue with Russia regarding the war. President Xi telling former Russian President Dmitry Medvedev China hopes relevant parties can stay rational and restrained, conduct comprehensive talks and resolve mutual concerns on security via political methods. Our team coverage starts right now with AMH down in D.C. and Maria Tadeo over in Berlin. AMH, just go through the latest and what we can expect a little bit later today.
Well, Volodymyr Zelensky, Ukrainian's president, is already headed here, and he tweeted that. And President Biden quote tweeted Jonathan saying he's having a good flight, and he looks forward and thrilled that he's coming. They have a lot to discuss. There's going to be a bilateral meeting in the Oval Office after we see President Zelensky touch down on the White House complex on the South Lawn. And then there will be a joint news conference between Biden and Zelensky. All of this before he goes over to the Capitol for a joint session of Congress to address Congress. And that really, Jonathan, besides the fact that it's shocking that he's coming here, it's the first time Zelensky is leaving Ukraine since February 24th, since Russia's invasion. The timing is really interesting for two reasons. One, we're going into these very critical months, and what we've seen in Ukraine is a barrage of missiles and drones coming from Russia attacking civilian infrastructure. This weaponization of the winter months are ahead. And clearly the Ukrainians are worried about that, and they want to make sure that aid continues. The second point, come January, we are going to have a Republican-controlled Congress. And we've already heard from who's poised to be the next Speaker of the House, Kevin McCarthy, saying there's not going to be a blank check for Ukraine.
Maria, AMH mentioned winter there, and we can talk about that blank check and the lack thereof in just a moment. But let's talk about winter. Maria, you spoke to the German finance minister about 30 minutes ago. What did he say?
Look, to me, there were three things that I take away from this interview. One is his 100% focus on inflation. He also endorsed very openly the actions of the European Central Bank. He says we had been saying this for a long time, that it should be inflation over everything else. So, of course, that is perhaps an endorsement that even a recession will not deter the German finance minister nor the ECB to continue to hike into this recession. Then secondly, he talked about the German car makers, the industry, the future for made in Germany. He says we have no reasons to worry over the medium term. We do not want a trade war with the United States, but he was crystal clear that he wants waivers on European products that get made in the United States to come and be approved by the Biden administration. And then thirdly, which to me, this was something I've never heard out of his mouth, he said, I am not concerned about Tesla. And by the way, you should invest now in Germany and buy bonds. That's coming from the finance minister.
Yeah, I never thought I'd hear the day that the German finance minister would be pitching a bund sale. But here we are. AMH.
He knows who he's talking to.
In D.C., Maria Tadeo in Berlin. Maria, thank you. Wonderful as always to the both of you. Just tremendous coverage through the year so far. On a big surprise for this year coming into 2022. This was not something that was in the 2022 outlooks for many. President Biden, President Zelensky, joint news conference coming up a little bit later, 4:30 Eastern Time. We'll take coverage of that for you on TV and radio. Back with us for a final thought, Jim Kieran, Darryl Cronk. Jim, we've talked about what we got wrong in 22, and the analysts were all over the shop. But one thing that we couldn't anticipate was this war that's broken out in Ukraine, what it's done to energy prices, how it's shaken up the European economy. Jim, how are you thinking about those themes going into next year?
I think those are all pretty key factors. Look, I think that Europe is going to struggle with energy prices for a longer period of time than maybe what some are giving, some thought to. I also think that inflation is the risk for inflation into 2023 is that it doesn't stay anchored. Inflation will come down in 23. There's no question about that. It's a question of does it get to target and does it actually stay there or do central banks have to come back in and start hiking again? I think that's the big risk that's out there. And certainly, we can look around the world and we can look at, Russia, Ukraine. Hopefully all of that gets resolved, peacefully and quickly at some point in time. But it doesn't seem that it's overly likely, even if there is some type of a truce, that all of the problems are going to go away, with energy and energy supplies and, where is all that Russian oil going to go and who's going to buy it and what have you. I think these are lingering problems for us to deal with over the next couple of years.
I'm hearing Goldman, B of A talking up triple-digit crude again next year. They don't think we've escaped any of this. Darryl Cronk, you get the final word, sir. The final word, please.
So I think the most underappreciated thing, John, into next year is the pressure on fiscal budgets, particularly let's just take the U.S. And its effect on inflation, right? So think about, we just got the omnibus budget yesterday. Defense spending is going up 10%, non-defense up 6% on the discretionary side, which is $1.7 trillion. The discretionary side, which is tied by law to indexing inflation on Medicare, Medicaid, Social Security, probably another $4.2 trillion. So fiscal is going to continue to spend, whether that's interest on the national debt, defense spending, or just the re-indexing of COLA resets on the entitlement piece of it. So that's going to add pressure to inflation that's going to keep it stickier and harder to come down. And people just aren't talking about, everybody wants to talk about the monetary side.
Yep.
Nobody's really talking about the fiscal side.
I agree. Jim Kerr, Darryl Cronk, to the two of you, thank you. And gents, thanks for everything in 22. Appreciate it. You've made this show a whole lot better. Looking ahead to doing more with them in 2023. Coming up, the morning calls and later, Bank of America's Jill Carey-Hall warning investors to avoid the mega caps next year, saying smaller is better. That conversation coming up shortly. Equity futures elevated near session highs, up 0.75% on the S&P. From New York, this is Bloomberg. We snapped a 4-day losing streak on the S&P yesterday, just about. We're trying to stage a rally this morning. Good morning to you. Up 0.7% on the S&P. On the Nasdaq, up 0.4%. That's the price action. Let's get you some morning calls. First up, Truist downgrading Carvana to hold, slashing its price target from 50 down to 5. That's helpful. The analyst pointing to elevated execution risk. The stock up 2% at 427. Jefferies downgrading Starbucks to hold, seeing limited upside as consumers pull back on spending next year. That stock at 96.81, down a little more than 1%. And finally, Morgan Stanley raising its Nike price target to 138, highlighting the retailer's impressive results despite a tough macroeconomic backdrop. That stock is flying post-earnings, up by more than 12% at 116.20. Coming up, Bank of America's Jill Carey-Hall making a case for small caps amid a looming US recession. We'll catch up with her in just a moment. And looking at the market right now, up 0.7% on the S&P. Your opening bell just around the corner. 23 seconds away from the opening bell. Good morning to you. It's Wednesday morning. Equities up by 0.75%. Equity futures on the S&P elevated, on the Nasdaq up by 0.4%. Small caps, big call from Bank of America's Jill Carey-Hall in just a moment on the small caps. Quite constructive relative to the large caps. We'll get to that call in just a moment. The Russell up 0.8%. There's your opening bell in New York. Switch at the board and get to the bond market. What a year it's been. The 10-year through 2022 up by more than 200 basis points. Through the curve, we've seen massive moves. The 10-year this morning, 363.97. Yields just a little bit lower by 4 basis points on a session. In the FX market, no real drama here. Negative 0.1% on euro dollar, 106.14. Crude just short of 78, just north of it now, $78 on WTI. We're positive by 2.3%. About 22 seconds into the session, the equity market elevated on the S&P, up by around about 0.6%. On the Nasdaq, up by about 0.5%. One stock to watch, absolutely flying since yesterday afternoon, Nike. Stronger than estimated sales, easing inventory concerns and pushing shares a whole lot higher. That stock is up by almost 13% at the open. Abby has more. Hey, Abby.
Hey, John. Well, yeah, big beat and raise out of Nike. It seems that some folks are willing to pay up for their favorite brand, even amidst the difficult macro environment. Now, relative to that sales beat, it was by almost 6%, $13 billion thereabout, profits of 85 cents. That is a 31% beat. The outlook they raised to low teens growth, and the sales growth on the quarter that they just reported, it represented 17% growth. So investors really liking this. But there's one area, most of the areas beat. North America by 9%. One of the closely watched areas, China, there was actually a little bit of a miss there. Their sales estimate fell by 3% to $1.79 billion. Some analysts, though, are saying inventories are a bit cleaner, so there may be some positive news out of that region looking forward. And you were mentioning those inventories. It's really interesting, John. So on a year-over-year basis, it actually jumped 43%. Management is saying it's a matter of perspective, that if you compare it to the 2021 low, that's why it's so high. But to that improvement you were talking about, days of inventory fell by 10 days to 106. So really pretty positive there. Now, it's interesting, John, into today, the stock heading to its worst year, going all the way back to 1993, down 38%. But with today's 13% gain, the best day since June of 2021, trying to chop away at that decline into the end of the year.
Big day of gains in store, potentially. Abby, thank you. Fantastic work. One more stock to watch. FedEx, another earnings beat. The CEO writing a statement saying the following: our results exceeded our expectations in the second quarter, driven by the execution and acceleration of our aggressive cost reduction plans. Kaylee on top of the story for us in the last couple of days. The good news, Kaylee, no September repeat here.
Yeah, that is definitely the good news investors seem to be clinging to today, with the stock up about 5% at the open. So eating into some of that 40% loss on the year through yesterday's close. Even though objectively this wasn't all good news from FedEx, they still are warning about a weaker demand environment, and their full year profit forecast did come in a bit light. They only see between $13 and $14 a share. Analysts were looking for $14. But we seem to be focusing more on the beat we saw in the second quarter, fiscal second quarter, when it comes to profit. Even though we got a beat on the bottom line, the top line actually did disappoint, and that is really what comes down to these cost cuts and also higher prices. That helped raise the overall operating margin. So let's just take a look at the Express business as an example. It is the largest revenue driver, so it's very important. Package volume there was actually down by about 12%, but revenue per package was up 16%. So it's making more money per package than a year ago, even though they are shipping fewer packages overall. And the same was true in the ground unit as well. So that weaker demand being offset by higher pricing as well as cost savings. FedEx had already told us 3 months ago they were planning for aggressive cost cuts. They now upped the ante yesterday, increasing their estimate of savings by about $1 billion. They are now targeting $3.7 billion in cost savings in 2023, John.
As Tom always tells me, companies adapt, and I guess that company is adapting. FedEx right now up by almost 6%. About 3 or 4 minutes into the session, equities elevated by 0.7% on the S&P, and the Nasdaq up by 0.4%. Here's the call from Bank of America. Jill Carey-Hall, sticking with small caps into the new year, writing the following: amid a year of two halves, we expect less downside risk for small caps relative to large caps near term. And once the market bottoms, that's typically the best phase for small caps. Jill, I'm pleased to say, joins us right now. So, Jill, let's take it from the top. Year-end target, 4K for next year. But I just get the feeling, Jill, reading your research, speaking to Savita recently, that you guys and the team are de-emphasizing the S&P, the index level. Why is that, Jill?
Yeah, and thanks for having me. Happy holidays. I think going into next year, we're looking for it to remain bumpy. We think there's potential. The S&P 500 hasn't bottomed yet. A lot of the indicators we're looking at suggest that the lows may not be in. So, typically the market bottoms about 6 months before the end of a recession, and our economists are expecting that we're likely to see a mild one, in the first half and into third quarter of next year. So we think there's potential the market could bottom sometime in the first half, and ahead of that, we're in a backdrop where we don't think the mega caps within the S&P 500 and a lot of the big growth and tech stocks that have been the leadership are poised to be the leadership in the next cycle. We think a lot of that part of the market is crowded. We see liquidity risk for the overall S&P 500. So we think that you want to outdex rather than index. So own the market X the top 50, or own the equal weighted index, or own small caps over large caps. So we see better opportunities in pockets of the market.
Well, let's get to that underweight in tech. So this year, as you know, some of these names have been absolutely hammered. Meta down 65%, Apple's down 25%, Amazon down 49%, Google 38%, Microsoft down 28%. Some people out there, Jill, conditioned by what's happened in the last 10 years, to your point, who believe looking at those losses, this is a buy. The argument for is that we've got peaking inflation, we've got the peaking Fed story, that this is a buy, we've had a terrible year, they can do better next year. What's the argument against that?
Well, I think, we've seen fundamentals for a lot of these stocks deteriorate. If you look at just the NASDAQ relative to the S&P 500, for many decades, the relative earnings trend was a straight line up. And now for most of this year, that's been trending downward. You've seen downward revisions or weaker fundamentals for a lot of these companies. Obviously, there's, regulatory risk to tech after being a largely unregulated sector. You have a lot of these stocks that have been more crowded. They outperformed for much of the last decade. But, typically, as I mentioned, we found that what leads in one cycle is typically different from what leads in the next. So we favor some of the other areas of the market in terms of more traditional CapEx beneficiaries. We think CapEx spending will be more resilient this time around. A lot of the big tech companies are still spending on CapEx, so we would rather own the beneficiaries, some of the automation beneficiary stocks. So select tech, but many of the industrials companies as well. And we still see energy as well positioned. That's still a very, inexpensive, not crowded area of the market with attractive free cash flow, which is one of the attributes that tends to outperform later in the cycle as well as in downturns.
It's one of your overweights. Here are the others. So we've got energy, utilities, staples, financials. Now, going into a downturn, you can make the argument for utilities and staples. Then you find energy and financials in the mix. Now, Jill, I was reading the note you put out in the last week. This is not your mom and dad's recession. You guys believe the performance of those two industry groups in a recession is going to be better than it has been previously. Jill, can you walk me through the thinking there?
Sure. I think for energy, this is still an area that, surprised many investors this year. It went from being a forgotten sector to now a much bigger weight in the index. Investors are still very underexposed to the sector. We do expect oil prices to be higher in 2023. Overall, a higher for longer commodity price backdrop. And, as mentioned, a lot of these energy stocks have attractive free cash flow now. They're paying attractive dividends. So, dividend income is one theme that we favor for next year. So energy really fits that theme. Financials is now a much higher quality sector than it was going into the last recession. It's now one of the highest quality sectors within the market, paying income. So that's another sector that when you look at energy, financials, even though these are more cyclical sectors, they've actually seen their betas decrease a lot. So they're actually sort of the new low beta sectors, where if you look at tech, communication services, they've actually become much higher beta sectors. So you've actually seen a shift in terms of the risks within sectors within the market.
They're the relative industry choices. Let's talk about small versus large. I talked about it in the introduction. You like small. Is that because you're looking across the equity market, looking at what's anticipating the downturn right now? Do you see that adjustment moving further along in small caps relative large, Jill? Is that what you see?
Definitely. I mean, I think, when you look at valuations, small caps have been trading at, 12, 13 times forward earnings. That's, lows we saw during the global financial crisis and below many of the recent recessions. And when you look at that relative valuation multiple of small versus large, we're pretty much at the lowest levels we've ever seen outside of, briefly during 99 to 01, which ended up being a really great buying opportunity for small caps over the subsequent years. So I think they're largely discounting a pretty severe recession at this point. And in addition, we think they're poised to hold up better given some of the macro fundamentals that we see, services spending holding up better than goods spending. Small caps are more services exposed. If you think about CapEx spending remaining more resilient, as I mentioned earlier, we've seen all this underinvestment by corporates for a long period of time, and now there's a lot of tailwinds to CapEx, reshoring of U.S. manufacturing. We're seeing a lot of evidence of that actually happening. Corporates, big tech companies spending on CapEx. So smaller, more domestic stocks are the ones that tend to benefit from CapEx spending by corporates within the U.S. So we think that they're actually better positioned, and given the inflationary backdrop as well, periods of high but slowing inflation, like we saw in the mid-70s to early 80s, a Fed taming a backdrop of high inflation, that tended to be a very good period to own small caps.
Hey, Jill, this was really thoughtful stuff. Just fantastic. I know that the year end is maybe just 4K and it sounds boring, but beneath the surface, you guys have got some really interesting calls. Jill Carey-Hall there over at Bank of America. Thank you, Jill, and thanks to the whole of the team over at BofA for their work done in 2022. It's been fascinating to have that ongoing conversation. About 10 or 11 minutes into the session, the equity market's up 6 or 7/10 of 1% on the S&P. Into the open, about 11 minutes into this on the NASDAQ, we're up by about 0.5 of 1%. Coming up, Elon Musk prepared to step down as Twitter CEO.
Basically resignation by remote control. I think he had a very good idea of what the outcome was going to be before he decided to actually put the poll on Twitter.
We'll have that conversation, plus closing out a tough year for big tech. We'll discuss with Michael Purvis of Toolpack and Capital Advisors. That conversation coming up shortly.
Basically resignation by remote control. I think he had a very good idea of what the outcome was going to be before he decided to actually put the poll on Twitter. He's receiving some heat from his shareholders. He's not paying enough attention to Tesla. The performance of the stock has been terrible, so he really needs to refocus back where his attention is needed.
Elon Musk confirming he'll step down as the CEO of Twitter. The billionaire is still planning on overseeing the company's engineering teams once he's found someone, quote, foolish enough to replace him as chief. This coming amid criticism that Twitter has been distracting Musk from his role as Tesla CEO. Ed Ludlow from London joins us now for more. Ed, I feel like I asked the same question because I can't keep up with any of this. What is the latest?
The latest is that he'll follow through with it when the right person comes along. We just don't have a good sense of when the right person will come along. Tesla shares really trading choppy at the open, were higher, then lower, up around 0.5%. That follows the biggest drop since October during Tuesday's session, and we're coming off a November 2020 low. The problem is that Musk is giving actually quite a lot of detail about the financial health of Twitter. But you and I have discussed over recent days and weeks that actually the sell side and the buy side are looking at these two stories. Twitter and Tesla are so closely intertwined. Musk got into a tussle overnight with a well-known fan of the company, Ross Gerber of Gerber Kawasaki, for example, and criticized him when Gerber said, can you just give us some clarity on what's going on successional at Tesla? When will you be going back to Tesla? You do go back to fundamentals, though. It's interesting to see the note from Mizuho in the last 24 hours saying, yes, Twitter's a part of this story, but we're starting also to think about the fundamentals, right? Consumer weakness in key markets like China and the United States. You have to remind yourself, Jonathan, this is a stock that trades at 33 times forward earnings. The Fed is still top of mind. And then you look at its performance on a year-to-date basis. As you know, this is a stock that's down 61% year-to-date. Much of that decline has come since October 28th, when Musk closed the deal to buy Twitter. So we're still focused on this idea of key man risk, that Musk is distracted at Twitter. But it was interesting to hear him speak, and the audience can go on the Bloomberg terminal and read the story I've written this morning on some of the financials around Twitter, where he justified the sort of severity of the cuts he made. We just need a name, Jonathan. Who's going to take this off his hands? Who can work for Elon Musk?
And no idea. I mean, who could work for him? I think many people could. Who can do that job? That's the big ask. Ed, thank you. Just fantastic out of London. Stripping this out, trying to tease this out is really tough. Leadership, one issue. The macro backdrop, all the automakers are struggling right now. Higher interest rates, you've seen the damage that's done to this equity market. The S&P on pace for its worst year since 2008, thanks in part to monster declines in the FANG stocks. Some of the biggest weightings in the index, together shedding trillions of dollars in market cap this year. Toolback's Michael Purvis expecting the tech sector to remain under pressure. He wrote the following in his outlook. Many big tech companies which have had secular earnings growth are showing signs of increasing economic sensitivity. Their business models are facing new challenges. The quality of earnings growth for this key sector won't be as impressive going forward. Michael Purvis, I'm pleased to say, joins us right now. Michael, year end, 36.50 next year. That gets our attention. Walk me through why this is a different regime and we're not going back to the pre-pandemic playbook anytime soon.
Well, you talked about the big tech earnings there, and I do think that, like for several years, we've all been waiting for this point in time when you can't have a secular growth story last forever, right? At some point, you get to terminal market share, and you're going to take on more economic sensitivity. And you're starting to see that in some of these wonderful tech business models. They're still wonderful, great business models, but they're just, the consistency and the quality of their earnings are not going to be what we've seen for the last 6 or 7 years. And you're starting to see signs of that in their earnings reports. And then, of course, there's idiosyncratic issues with some of these companies as well, Meta being exhibit A of that. But I think my broader, reason why I'm at 36.50 is really not that I'm predicting a recession, some, avalanche of horrible economic data. In fact, I think it might actually continue to sort of outperform at least bearish expectations. But I think what is happening here across asset classes is that we've largely processed a lot of the COVID era stimulus in terms of its inflationary impacts, supply chains, and all that. But there's new structural factors that are coming just as these things are starting to fade, and those include a very different commodity story with very tight supply on both metals and energy. On the hydrocarbon side, you're seeing deglobalization, which is actually going to be in many ways very good for Main Street America, but it's also inflationary. And then of course you have your employment structural employment changes that has been problematic for the Fed, and I think will be increasingly problematic for those that expect rate cuts to materialize in the second half of next year. So I think what I'm sort of saying here is that the earnings situation is not going to collapse next year, but you're not going to go back to see this, this really wonderful, uptrend in earnings, particularly with some of the sort of moderate contraction in real growth and also inflation. And in some ways, I'm more worried about falling inflation hitting earnings than I am necessarily a recession there. So I think it's a lot of regime shifts happening all at once. And to get back to the, sort of the buy the dip that we've seen coming into last winter for so many years, I just think we're in a different era where the old economy is coming over and then you've got new challenges. And so, inflation will continue to fall, but can we get to the 2% target by next December? I'm not so sure we can.
So, Michael, what I hear from you is that we're leaving behind a regime of structural disinflation and replacing it with a regime of structural inflation. Can you talk to me about that, how that shapes potential leadership in the equity market going forward?
Yeah, well, I think if you think what's driving that, some of these new pro-inflationary forces, things like deglobalization, that means you're going to see strong earnings from the industrial sector. I think the energy sector, even if oil prices don't get back to triple digits, are still going to be, outperforming on the earnings side. And look, I'm not saying Google's going to earnings story is going to fall apart. Absolutely not. I'm just saying that the consistency and the magnitude of the earnings growth will not be what it is. It's going to lower Sharpe ratio for big tech earnings going forward, and that's, there's still a huge weight in the index, and so that process is a little bit more volatile. I think in some of the other sectors, look, banking may be big banks may actually do better than expected, at least on the net income margin front there. Retailers is very much a mixed bag here, with a lot of very, very specific challenges trying to sort through shifting consumer demands amidst some of the strangest supply chain shifts we've seen in some time here. There. So, again, I don't think the earnings story is one at the index level is going to be a collapse, but it's not going to be a big expansion. I think it's sort of a sideways grind through next year and then into 24. And the problem is that you're still going to be in this two-way volatile market with a lot of tactical sort of tight moves there. It's going to be hard to be a long-term investor next year. It will be the opportunity set for agile traders is robust, but what we buy big tech and sit back and watch the index put up double-digit returns for 4 years in a row, like we just had it coming into last winter, that is just not coming back anytime soon. And I don't see what the path is to getting back to that, particularly with some of these sort of pivot points in the big tech earnings stories.
Well, this year was difficult, and from what I hear from you, the next year is going to be equally as hard. Year end, 23, 36.50. The call from Michael Purvis at Toolback, and really nuanced read from Mike. Mike, thank you, sir. Appreciate that, and have a fantastic new year to you as well. Coming up, we'll bring you the trading diary from New York. Stocks are higher. This is Bloomberg. Equities positive here. Let's get your trading diary. Coming up very shortly, existing home sales and consumer confidence at the top of the hour. President Biden, Zelensky holding a joint news conference at 4:30 Eastern. US GDP, core PCE, another round of claims coming up next Thursday. Durable goods, personal income spending numbers on Friday. Then we close out a week with you, Mitch. And I close out the year right now. So before I rush off for the holidays, special thank you for all the hard work that goes into this show. My team do a fantastic job of making me look good, even when I'm really bad. And a special thanks to you at home. I say this a lot, I know. You've heard me say this before, but every time I say it, I mean a little bit more. You are the most intelligent audience on the planet. Thank you for making me sharp. Thank you for making me smarter. Have a wonderful Christmas and a very happy New Year.